Warren Buffett is walking away from Berkshire Hathaway, and he's leaving behind the biggest cash reserve in the company's history. We're talking about $347 billion in cash. That's not just a big number. It's nearly the same as the GDP of Colombia. It's enough to hand out $1,300 to every adult in America. Yet somehow, according to Wall Street, this move is supposed to be worrying us. As Buffett prepares to step down as CEO, his latest moves are raising eyebrows because they go against what many expected. Only a few times in his legendary career has he stockpiled this much cash. Right now, it makes up nearly a third of all Berkshire Hathaway's total assets. That's a record. The last time his cash levels were even close to this was in 2006, right before the global financial meltdown. Then again in late 2021, just before the 2022 bear market, and also in 2000, just ahead of the dot-com crash. This isn't luck. Buffett has a reputation for sidestepping financial disasters with perfect timing. That's why people call him the Oracle of Omaha. Take a look at how Berkshire's stock has fared versus the S&P 500 over the decades. When recessions hit, like during the dot-com bust or the 2008 crash, Berkshire didn't just survive, it thrived. Why? A big reason is that Buffett had more cash on hand when it mattered most. Which brings us to today. Is Buffett's cash-heavy strategy a signal that something big is coming? It might seem that way, but Buffett himself says that's not his mindset. He doesn't try to predict recessions. In fact, he's openly skeptical of economists. His philosophy? Simple. Buy great companies at fair prices. If those deals aren't available, he holds on to cash. And right now, those good deals are rare. By most metrics, the U.S. stock market is massively overpriced. One of Buffett's go-to valuation tools, now nicknamed the Buffett Indicator, measures the ratio of the entire U.S. stock market to the country's GDP. That number is now over 200%. In plain terms, the market is worth twice as much as the U.S. economy. That's the most overvalued it's ever been. We've only seen this kind of extreme reading two other times, during the dot-com mania of 2000 and just before the 1970s recession. So it's no surprise that Buffett hasn't been buying much. He's waiting. But let's be clear, these metrics aren't a crystal ball. Markets can stay expensive for years. But over time, prices tend to return to their long-term averages. That's what Buffett counts on. He's not trying to guess the next crash. He's waiting for moments when great businesses are undervalued, and then he goes all in. And when the market gets too hot, he steps back and holds cash. If you had followed this logic, buying in 1982 or during the 2009 crash would have given you a decade of outstanding returns. Holding cash in 1999 or 2006 would have saved you from major losses. That's why Berkshire Hathaway has returned more than 1,400% over the last 25 years, around 15% compounded annually. That's nearly 5 times better than the S&P 500, which returned just 300% over the same period. So what does this mean for investors like you and me? Well, first off, don't freak out about Buffett's cash pile. Instead, pay attention to what he's actually buying. Recently, he's been adding to his positions in companies like Ally Financial, the chemical maker Chemtrade Logistics, and the railroad BNSF. These aren't random choices. They reflect Buffett's timeless investment approach. Buy businesses you understand with strong competitive advantages and a history of generating cash flow. It's not about chasing the hottest stocks or betting on the next big thing. It's about finding solid, reliable companies that can weather any storm. Now I know what you're thinking. You probably can't invest in Berkshire Hathaway stock because it's way too expensive for most people. Well, here's the secret truth. You actually can own a piece of the Oracle's wisdom without breaking the bank. I'm not kidding. Just take a look at the numbers. Back in February 2023, Berkshire stock was hovering around $318,000. Today it's trading at around $293,000. That might seem like a small dip, but it's actually a golden opportunity for savvy investors like you. Buffett himself has been trimming down his equity positions, suggesting that he believes the current market is a bit pricey. That's where you come in. By reducing his holdings, Buffett is essentially saying there are better opportunities elsewhere, hinting that the market might be due for a correction. It's like getting a sneak peek into the mind of a legendary investor. So here's the bottom line. When Buffett starts shifting his portfolio, it's time to sit up and take notice. Don't panic about his cash stockpile. Instead, focus on his investment strategy and consider what he's been buying. Remember, the key to success is often hidden in plain sight. While everyone is busy obsessing over Berkshire's stock price, take a step back and analyze the bigger picture. Focus on Buffett's investment choices and the underlying value of the companies he's buying. Because let's face it, who wouldn't want a piece of the Oracle's wisdom in their portfolio? So there you have it. If you found this insightful, please don't forget to hit the like button. It truly helps us spread our message to more people. Your support means everything to us. Thank you.